Welcome to the Trinidad and Tobago Securities and Exchange Commission's webinar entitled Getting Financially Fit. Before we get started, I would like to state that we are not here to tell you where you should invest or how to make more money, but rather we are here to ensure that you understand what information you need in order to make sound investment decisions and what your rights and responsibilities are as a consumer of financial services. The Trinidad and Tobago Securities and Exchange Commission, or TTSEC, is the sole regulator of the nation's capital market. This includes the market for stocks, bonds, and mutual funds. Our fellow regulator in the financial services sector is the Central Bank of Trinidad and Tobago, which regulates the banking and insurance sectors. For those of you who may be interested in statistics, the value of the securities industry stood at $307 billion as at October 2015. This represents 186% of our country's GDP. The Trinidad and Tobago Securities and Exchange Commission is the regulatory body mandated to look after the interests of investors in Trinidad and Tobago. We protect you by registering all persons who deal in securities. Check the list of registrants on our website www.ttsec.org.tt before engaging in any securities transactions. Ensuring that all of the information about the security that an investor would need in order to make an informed decision is disclosed, both to the Commission and to potential investors by the market participant. Conducting routine market surveillance and investigating possible breaches of the Act, including from customer complaints. Enforcing rules through the use of orders, guidelines, and bylaws. Conducting a multimedia investor education program designed to provide investors and potential investors with suitable information to guide informed decisions. New Year's resolutions often include getting physically fit. But how is your financial health? As part of our investor education program, we are pleased to provide some tips to help you on the road to becoming financially fit in 2016. Most people associate audits with big business. However, auditing your financial status is just as important. Consider these questions. Have you properly assessed your assets and liabilities? Are you satisfied with the money you earn? Have you prepared for your further education? Have you catered for your children's education? Do you have an emergency fund? Have you begun to prepare for retirement? Now that you've considered these questions, what is the next step? Plan. Make a plan mapping out what you would like to accomplish in the next 5 years. This plan may include purchasing a car, a home, tertiary education, or opening up your own business, just to name a few. In order to achieve all of these, you need to plan. Determine how much money is required. Examine your income and assets. This will include determining your level of savings, your ability to obtain loans, and your access to assets that can be converted to cash. With this information in hand, you can work out the time frame needed to achieve your goals and can now create a detailed plan of how you can achieve those goals. Manage your debt. It is important to have a healthy credit rating. The only way to have this credit rating is to have incurred debt and repaid it on or before the date it is due. The more you meet your debt obligations, the more you become creditworthy. The cardinal rule is to never let your debt exceed your income. You must always be able to meet your debts, even if you find yourself out of work for a short or extended period of time due to an unforeseen emergency. More importantly, as you plan for retirement, it is important to work to ensure that you are free from major debt at least 5 years before the mandatory age of retirement. Your next step is to make a budget to avoid the temptation to buy everything your heart desires. This should be your order of priority. Meet all of your fixed expenses. Clear off all of your debt. Satisfy your needs and then see which of your wants can be met. Savings. Savings are not generally meant for long-term wealth creation. They are considered short-term, under 5 years, after which they can be converted into other higher interest generating opportunities. They generally are placed in instruments with low risk and they are easily accessible. One of the best ways to save is the concept of paying yourself first. This is simply creating an automatic instruction or standing order to allow a specific sum of money to be deducted from your salary before you get it in your hand. Start by putting aside a minimum of 1/10 of any income that you receive before you spend out of it. Always remember, though, to modify your plan, including the increase of your standing order deduction as your situation changes or your salary increases. This money should go into a separate account which does not have an ATM card that allows for easy access. Tax returns, bonuses, and back pay or any other financial windfall should also be set aside in this account. Ensure that you have at least 6 months' salary put aside in the event of an emergency before looking at other options for growing your wealth. Finally, if you have the opportunity, join a company-subsidized pension plan. If not, create your own. Bank accounts. You can open a savings or fixed deposit account at a bank. A fixed deposit account is one example of a short-term savings option that provides the account holder with a fixed rate of return. In return, the holder agrees not to withdraw or access his or her funds for a fixed period of time. Interest is only paid at the very end of the period. This is unlike regular savings accounts, where interest is calculated daily and typically paid to your account at the end of each month. You can access this money at any time. It is important to note that deposits in banks and other financial institutions that are members of the Deposit Insurance Corporation of Trinidad and Tobago are insured for up to $125,000. Credit unions. A credit union is a member-owned financial cooperative. Members invest their money into the credit union in exchange for shares. Each year, the credit union gives its shareholders dividends based on the performance of the credit union. Members can also use their shares as collateral for loans. At the end of the loan period, the shares remain the members' property and can be used as collateral once again. Annuities and pension plans. An annuity is a contract with a life insurance company that is most commonly used to generate retirement income. Please note that the responsibility for supervising banks, insurance companies, and credit unions rests with the Central Bank of Trinidad and Tobago. This is not the remit of the TTSEC. Investments. Investments can be short-term, but are generally held for periods of 5 years and over. With investments, the money is invested in assets whose value can rise or fall. However, there is no guarantee that you will get an increased return or even recover your original investment. The greater the opportunity to get high returns, the greater the risk. After having ensured some substantial savings to cushion you in the event of any unplanned events, you may consider investing. Information is the key to understanding your investment options. You should always obtain the services of a registered financial advisor to help you to Understand your investment options, determine your risk profile, crystallize your investment objectives, and develop a financial plan. Remember, financial advisors must be registered with the TTSEC to do business. You can find a list of all registered financial advisors by visiting our corporate website at www.ttsec.org.tt. Now let's discuss the basic steps in investing. The first step towards achieving your financial well-being is to set your goals. You will make better decisions about your money if you develop and follow a plan for investing. Ask yourself these questions and write down your responses. What are my top 3 financial goals? When do I hope to achieve those goals? How much money do I need to attain those goals? Step 2. Find out what type of investor you are. Investing is about choices. Your investor profile is determined by the choices that you make. You can determine your profile by asking yourself these 4 questions. How do I want to approach investing? How important is it for me to keep my money safe? How comfortable am I with risk? How important is it to me to make a good return on my investments? Step 3. Determine your investment objectives. It is safe to say that most investors have 3 broad objectives. They want investments that are safe, generate attractive returns, and are easy to access in case of an emergency. Unfortunately, you don't often get all these wrapped up in one perfect investment package. Step 4. Select your investment options. There are a wide variety of investment options from which to choose. Your choice depends on the following: the amount you have to invest, your investment goals, the time frame within which you expect your return, and the level of risk that you are willing to take. What does risk mean? Simply put, risk is the degree of uncertainty about the return an investor would earn on an investment. In effect, this means that there is the possibility of an investor incurring a loss on his or her investments. Remember, the higher the return, the higher the risk. That higher return is your compensation for taking on the additional risk. Before you start investing, you must determine whether you consider yourself to be a risk taker or not. That risk profile determination will guide you in determining the types of investment instruments best suited to you. We will now explain the 4 main classes of investment products which you can use to increase your wealth. The first one does not fall under the remit of the TTSEC. Real estate. This includes land and buildings. Their value tends to appreciate over time. The next 3 that we will discuss are under the remit of the TTSEC, and they are generally described as securities. So what is a security? These are investment instruments which not only have a financial value and can be used to create wealth, but they can also be traded or transferred. The main classes of securities registered with the TTSEC are equities such as stocks and shares, debt instruments such as bonds, and mutual funds. Equity. This represents a share in ownership of a company, otherwise known as stocks. Companies that list on the stock exchange offer to sell investors a part of their company, which then gives them certain rights and benefits. Shareholders benefit from dividends on either a quarterly, semi-annual, or yearly basis, dependent on the stock's performance in the financial year. You can consider it a share of the profits when a company does well. Owners or shareholders also can receive capital gains based on the upward movement of the stock's share value. This benefit only occurs when you sell your shares. Here's an example to help you better understand capital gains. Let's say you bought stock X in 2010 for $40 per share. Despite the ups and downs of the market, the stock price in 2015 has risen to $85 per share. This means if you had bought 1,000 shares in 2010, you would have spent $40,000 to obtain those shares. In 2015, those same shares would have appreciated in value and are now worth $85,000. Therefore, if you were to sell your shares at this point, you would have made a profit of $45,000. It is important to note that the value of securities go up and down in a cyclical manner, as can be seen in the examples on the next 3 slides. These graphs are merely for demonstration purposes, representing the upward and downward movement in the value of securities over time. Various factors within the local and global economy will impact the value of stocks traded on the stock exchange. We come now to debt instruments or bonds. These are essentially a loan arrangement between the issuer of the bonds, a borrower, and the purchaser of the bonds, an investor or a lender. Bonds are offered to raise money for capital projects. The investor is lending money to a company or a government. There is a periodic interest payment, and money is paid in full at maturity. To show how this works, let's use this example. If the government wanted to build a new port, it could issue a bond, that is, raise funds or borrow from institutional investors such as banks and other financial institutions, as well as the general public. These are the lenders. For this, the lenders will receive a set rate of interest on the sum loaned. During the period between when the bond is issued and when it matures, the investor receives a periodic interest payment known as a coupon payment. When the duration of the bond comes to an end, it is called the bond's maturity date. On that date, the company or government that borrowed your money is supposed to pay it back in full. This amount is called the face value of the bond. At the end of the repayment period, the lenders will have gotten back their principal as well as the interest. Bonds are usually long-term in nature and can go for up to 30 years. Some investors sell their bonds before they reach their maturity date. However, you can lose money by doing this since you forego some of the interest payments you would have gotten if you kept the bond to maturity. Cash and cash equivalents. These are highly liquid investments with maturities of 3 months or less. In essence, these are monies that you can easily walk into a financial institution and retrieve, and hopefully you don't keep under your mattress. Mutual funds are investment instruments. They are considered to be cash equivalents because of the frequency with which liquidity is available. However, many investors who own them do not even understand what they are or how they work. Mutual funds comprise investors' funds which are pooled and invested in a combination of stocks, bonds, and other types of financial instruments. Investment decisions are made by dedicated fund managers who manage your portfolio mix in order to match your risk profile and get the most return on your investment. Investors are therefore able to diversify their holdings so that a failure by any specific instrument does not necessarily have a devastating effect on the entire portfolio. Unskilled investors do not have to make decisions on their own about each financial instrument in which they invest. Therefore, they benefit from the expertise of professional investment managers. Always remember what your grandmother used to say, don't put all your eggs in one basket. Keep your portfolio diversified with a mixture of investments with varied risk. That way, if one or more does not perform as expected, all is not lost. Let's recap. Here are 12 tips to get you financially fit. 1. Plan. Map out what you would like to accomplish in the next 5 years. Create a detailed plan of how to achieve your goals and modify your plan as your situation changes. 2. Clear your debt. Work to ensure that you are free from major debt at least 5 years before the mandatory age of retirement. Take advantage of tax savings using tax-deferred instruments. 3. Budget. Make a budget to avoid the temptation to buy everything your heart desires. Meet all of your fixed expenses, clear off all of your debt, satisfy your needs, and then see which of your wants can be met. 4. Save, save, save. Start by putting aside a minimum of 1/10 of any income that you receive before you spend out of it. Ensure that you have at least 6 months' salary put aside in the event of an emergency. 5. Be informed. Understand your investment options. Save or invest any financial windfall that you receive. 6. Seek out a registered financial advisor. Obtain the services of a registered financial advisor to determine your risk profile and to help you match your goals to a financial plan. 7. Save for retirement. As your income increases, so too should the money you put aside for savings. Create and save in your own retirement fund. 8. Share the wealth. Consider investing in the stock market directly or through a mutual fund. Don't put all your eggs in one basket. Ensure that you have a portfolio mix made up of different types of investments with varied risk. 9. Choose wisely. Purchase assets that appreciate in value over time, such as real estate. Consider the purchase of real property, which can supplement your retirement income. 10. Monitor your investments. Monitor all of your investments routinely and adjust accordingly. Where possible, participate in a company contributory pension plan. 11. Got insurance? Ensure that you have appropriate insurance coverage so that your retirement savings are not eaten up by medical expenses. Ensure that you are as careful with your finances now as you were when you were younger. And 12. A quote from the Joker, Heath Ledger, in The Dark Knight. If you're good at something, never do it for free. Turn a hobby or passion into additional income, tutoring, interior decorating, coaching. Use your successful life story to help others learn how to be financially fit. It's important to start making the proper lifestyle changes for you and your family in order to live a happier, healthier, and more financially stable life. We've discussed many investment options and tips to help you pump your investment muscles. If you want to learn how to get fit in 2016, remember these 3 simple points. Find out your investment options. Consult with a registered financial advisor to explain the options and select your portfolio mix. Invest in the local stock market. Investing is one way to make your money grow. Remember, though, that higher returns usually mean higher risk. Track the performance of your investments. After investing, it's always important to review your investments and ensure that they are continuing to meet your financial goals. In the event you are dissatisfied with the service of a registered financial advisor or entity, you can lodge a formal complaint to the Commission by doing any of the following: downloading and completing a complaint form, which is available on the TTSEC's website, www.ttsec.org.tt. The form, along with copies of any supporting documents, can be posted, hand-delivered, or emailed to the Commission. Visiting the Commission's office, located at 57 to 59 Dundonald Street, Port of Spain, with supporting documents to lodge a complaint. Calling the Commission's complaint hotline 624-2991, extension 1611, and lodging a complaint. Upon receipt of the complaint, staff of the Commission will inquire into the details of the complaint to determine if there has been any breach of the securities laws and take requisite action. Thank you for participating in our 5th Investor Education webinar. Your feedback is important to us. Feel free to send an email with your comments and suggestions to ccei@ttsec.org.tt. You can also view our previous webinars by visiting our Investor Education site at www.investuktt.com. I hope you have a productive day and that these tips will help you to be on your way to becoming financially fit.